Welcome to the Exit Plan Show. Today's guest is Tim Scott. He's the founder of Wallace Scott Law Firm in Denver, Colorado. Stick around to the end of this interview and we're going to show you how you can subscribe to our newsletter, download some free guides, and maybe win a free book. Thanks for joining us. Thank you to Zarlingo Robb, CPAs and Business Advisors in Wheat Ridge, Colorado, for providing a location for us to film this episode. At Zarlingo Robb, they think like business owners. For more information about Zarlingo Robb, please click the link in our website show notes. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors like today's guest, Tim Scott, to help business owners like you enjoy more personal freedom, grow your company faster, and retire someday on your own terms. Tim Scott is with the Wallace Scott Law Firm in Denver, Colorado. His practice areas are estate planning and administration, business and individual taxation planning, exit and succession planning, tax controversy representation, entity formation, and business growth and incentive planning. Welcome back to the show, Tim.
Thank you.
Today we're going to talk about business and individual tax planning, and there are lots of ways to do that. Something that comes up more often than I would have expected is charitable remainder trusts. They don't always get implemented, but they get brought up a lot. So can you just fill people in a little bit about charitable remainder trust?
Absolutely. There are charitable remainder trusts at their core are a type of a vehicle whereby an individual makes a payment to for the benefit of his or her heirs, but the remainder is the charity is named as a beneficiary, or charity or charities. Mm-hmm. And there are a couple of types of charitable remainder trusts, and not to get too far in the weeds, but it's important to understand for the audience. Mm-hmm. And there is a charitable remainder annuity trust, mm-hmm. which is less favored these days because it does mandate a specific dollar amount be paid out to beneficiaries before the trust, mm-hmm. Or before the charity, I'm sorry. But the issue then becomes if they're underperforming assets, yet we have a fixed dollar amount, mm-hmm. then we have possibly a problem with the trust and its ability to actually generate enough of an asset to distribute to the charity upon passing. Mm-hmm. And then we have a charitable remainder unit trust, which mm-hmm. is a more popular way of looking at things with the charitable remainder planning, which is a percentage of the assets which fluctuate high and low. But at its core, it's a nice technique because it does a couple of things. Mm-hmm. One is that it can, the way that it's properly set up, achieve some level of income tax deduction mm-hmm. to the client. Okay. So a current income tax deduction, and then the estate tax benefit is that the remainder being passed on to the charity. Then we have no estate tax ramification associated with that. So if someone were selling a company, had a low cost basis, for example, and had a lot of taxable income upon the sale, is that an area where a charitable remainder? Absolutely. It's a great point, yes. Okay, good. Besides the charitable remainder trust, there are a lot of other strategies a business owner can do to reduce taxes. Let's talk about short-term strategies. What's something that someone could do maybe 1 to 3 years ahead of time? So short-term tax strategies, this is a perfect time to talk about that because I have actually a phone call this week with a client who needs a short-term tax strategy for his investment business. Mm-hmm. And he is in a unique situation to, say, vis-a-vis, say, a manufacturing business where you may have a bunch of property that's depreciable, for example. In this case, this gentleman doesn't have that kind of quick tax advantage. So we have to look at things like, for example, the implementation of a defined benefit plan. Mm-hmm. He's going to be able to sock away a bunch of money potentially into a defined benefit plan and take an income tax deduction and allow his money to grow in a certain tax advantageous manner. We're also looking if there is still the ability for, we mentioned depreciation, for bonus depreciation or mm-hmm. Even Section 179 immediate cost. To take that as a nice deduction, I guess you could, deduction mm-hmm. as far as income is concerned. So it's never too late. You should plan ahead, but then if you haven't planned quite far enough ahead, there's still some things you can do in the last 1 to 3 years to Absolutely. Help. Okay. Absolutely. Great. And now let's talk a little bit more. Let's go beyond the short term into the long term. How about like a 3 to 10 year time horizon? What are some areas you could look at? So there are a couple of things that I wanted to talk about in response to that question. I mean, one is more of a sort of a broad-based response to that, which is, planning ahead of time in terms of cost, in terms of capitalization of new business areas, in terms of if you're going to, we see this happen where you buy vehicles or buy a fleet of vehicles or buy something that you can depreciate over time, amortizing certain intangible assets. Those types of things take a while to go to actually fully depreciate or amortize. But there are some other neat advantages that we see, for example, putting together a deferred compensation plan, whereby that could take some time to actually manifest itself, but the recipient or the employee doesn't recognize income until paid, so that can be a nice long-term strategy that will tie in later to our interview today about deferred compensation and incentive planning.
Okay, we're going to get into entities too, which I'm sure you'll have some ideas to add there. Okay, perfect. Okay, so that wraps it up. For more information about Tim and Wallace Scott Law, please go to our website. And while you're there, you can subscribe to our newsletter. You can download some free guides, and you'll have opportunities to win lots of free books about exit planning. Thanks for joining us.